Have you ever wondered how professional traders filter out bad trades and confirm the best setups? Well, the secret lies in trading convergence. It's a powerful tool that aligns price action with indicators to confirm trend strength. So in this video, we are going to be breaking down what trading convergence is and why it matters. We're also going to be looking at how to spot it using RSI, MACD, moving averages, and volume. We're also going to be breaking down step-by-step strategies to trade convergence like a pro. So if you're serious about improving your market analysis, smash that like button and subscribe for more expert trading insights. Okay, let us just dive right in. Trading convergence happens when price action and indicators move in the same direction. It's as easy as that. Okay, so it helps to confirm the strength of a trend. So this is the opposite of divergence. You know that divergence is usually where price and indicators move in opposite directions, signaling a potential reversal. For example, I'm just going to add MACD to the chart just for the purpose of this example, right? If price is making, let's just do this real quick. Okay, if price is making higher highs and higher lows, for example, yeah, price is making higher highs and higher lows, and indicators like MACD or even RSI or any other indicator that usually used to depict divergence is also rising. That's a strong confirmation that the trend has momentum. Why is this important? Because trading with convergence reduces the risk of false breakouts and fake reversals. So there are four key indicators that work best when looking for trading convergence. Let us start with the MACD, also called the moving average convergence divergence. So you have to look for the MACD line and signal line moving in the same direction as price, like what we identified here. If price makes a higher high and the MACD follows, it confirms that this trend is strong. The next indicator we are going to be looking at is the relative strength index, or the RSI for short. If price is trending upward and the RSI is also moving higher, let's look for another example, because at this point the RSI was in the overbought territory. So let's just look for another example where the RSI gave a convergence, right? Okay, we can see that here price was trending upward and the RSI was also trending upward. So we had a convergence at this point. Okay, it signifies strong buying pressure. But if the price is falling, and the RSI is also falling, it indicates strong bearish pressure, meaning that the trend is likely to continue. Now, the next indicator we are going to be looking at is the moving average. Okay, moving average. We're going to be adding both the 50 EMA. We're going to be adding the 50 EMA and the 200 EMA. So these are the two moving averages we are going to use. Okay. All right. So when you have price staying above an upward sloping 50 EMA and 200 EMA, or you can even decide to use just one of the moving averages, okay, depending on your trading style. But when you have price trading above the moving averages, it signals strong convergence. If price is below the moving averages, a downward sloping. When price is above the upward sloping, signals strong bullish momentum. When price is below, remember that the moving average has to be sloping upward for you to confirm your convergence, right? Then in the case of a strong bearish momentum, the price must be under the downward sloping moving average to confirm bearish momentum. Then the next indicator we are going to be looking at is the volumes indicator. Okay, when you have a rising trend with increasing volume, it supports the price strength. On the other hand, if volume is dropping while price moves, the move might lack conviction. So by checking these indicators together, you can validate the strength of a trend before entering a trade. So now that you know how to spot trading convergence, let us go over two powerful strategies you can use right away. The first strategy is trend continuation strategy. You can identify an uptrend or a downtrend where price is making higher highs or lower lows. All right, where price is making higher highs or lower lows. And then also confirm convergence with RSI, MACD, and moving averages moving in the same direction. Then you can enter on a pullback. For example, if it's a buy, you can enter on a pullback. It's a good place to enter. Okay, a pullback to a key support for a buy or a key resistance for a sell. Then set your stop loss below the previous swing low for a buy trade or above the previous swing high for a sell trade. Now the next strategy is breakout confirmation strategy. You wait for price to break a key resistance or support level. For example, here you can see the breakout that happened from this resistance that identified here, right? So after the price breaks out, you look for MACD crossing, above the zero. Ensure that the MACD is above the zero level. RSI should be above the 50 level, and watch out for increasing volume. So we had a valid signal here. Then you can enter after the breakout is confirmed with strong convergence. Then you can exit when the first sign of divergence appears. All right. When the first sign of divergence appears or when price hits the next key level. Okay. So by using convergence, you increase your chances of riding strong trends while avoiding weak breakouts. Even though trading convergence is powerful, many traders make mistakes that cost them trades. So let us just go over the top 3 errors. The first is ignoring volume. If price is moving up, but volume is decreasing, the move might not be strong enough to continue. Watch out for this. When the volume started decreasing, it showed that this buy move was coming to an end. Can you see? You can see. So this signaled that the buy move was coming to an end as the volume started decreasing. All right. Now, do not also make the mistake of using just one indicator. Never rely on just the RSI or the MACD or moving averages alone. Always confirm convergence with multiple signals. And finally, do not make the mistake of entering too late. If price has already moved too far, you might be chasing the trend. So just look for early signs of convergence to time your entries better. Avoiding these mistakes will help you trade with confidence and precision. Now, which time frame works best for trading convergence? The 5-minute and 15-minute charts work best for scalping and short-term day trades. The 1-hour charts and 4-hour charts are ideal for swing traders looking for stronger confirmation, while the daily chart is best for long-term trades, long-term traders and position trading. Now, the key is to use a higher time frame to confirm trends before taking a trade on a smaller time frame. Okay. Now, let us just quickly recap. Trading convergence happens when price action aligns with indicators like RSI, MACD, and moving averages. You use multiple indicators together to confirm strong trends and avoid false signals. The best strategies include trend continuation and breakout confirmation using convergence. Okay. Also, ensure you watch out for common mistakes like ignoring volume and relying on just one indicator. Make sure you use the right time frame based on your trading style. If you found this video valuable, hit that like button and drop a comment below. Do you use trading convergence in your strategy? And don't forget to subscribe for more in-depth trading strategies. Turn on notifications so you never miss an upload. Thank you for watching, and I'll see you in the next one.